Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic, the sale of non-current assets. You can see the question on the left hand side of your screen, and on the right hand side we've got all the workings which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. On the 1st of July 2020, Yasmin Trading bought a motor vehicle costing $90,000 and paid by check. On 30 June 2022, the business sold this motor vehicle on credit for $60,000 to Mr. Ong. The business depreciates its motor vehicles at a rate of 20% per annum using the reducing balance method. A full year of depreciation is charged in the year of purchase and no depreciation is charged in the year of sale. The financial period for this business ends on 31 December. So the first requirement of this question is to prepare the journal entries and record the sale of non-current asset on 30 June 2022. And the second requirement is to find any gain or loss on this sale. So let's look into the workings on the right hand side. So year one of usage for this motor vehicle would be from 1 July 2020, which is the day we have purchased it, and ending on 31st of December 2020, because that's when the business will be preparing its financial statements. All right, and the business clearly has a financial period ending 31 December, which the question mentions. Based on the business policy, we are to apply a full depreciation in the year of purchase. So in the year of purchase, the full depreciation is calculated by multiplying the given percentage with the original cost. The given percentage is 20 and the original cost is $90,000, which gives us a full depreciation in year one of $18,000. Now, what I recommend you always do every time you have the reducing balance method is to find the net book value at the end of the financial year. How do we find the net book value at any given point in time? We simply find the difference between the original cost and the accumulated depreciation. The original cost is $90,000, which is given in the first line of the question, and the accumulated depreciation, which is the total depreciation, is the only depreciation expense that we have incurred in the first year of usage, and that is $80,000. So this gives us a net book value of $72,000. Now in year two, which would start on 1 Jan 2021 and end on 31st of December 2021, using the reducing balance method, the depreciation is calculated by multiplying the given percentage with the net book value. So the given percentage is 20, clearly mentioned in the question, and the net book value at the end of the previous year was $72,000, which gives us a depreciation of $14,400 for the second year ending 31 December 2021. Now, the net book value at the end of year two can be calculated by taking the net book value which we had at end of previous year and then subtracting the additional depreciation, which takes care of the accumulated depreciation or total depreciation in a way, and gives us a final net book value of $57,600 at the end of year two on 31 December 2021. All right. Now, year three for this asset would therefore start on 1 Jan 2022 and end on the day of sale, which is 30 June 2022. And based on the business policy, which is clearly mentioned in the last line of the second paragraph, no depreciation is charged in the year of sale. Now, how much did we sell this asset for on credit, or what is my expected proceeds by selling this asset? It is $60,000, which I expect to get from Mr. Ong in the future. The net book value of this asset is $57,600. What do we understand by the net book value? The net book value at any given point in time simply refers to the economic value that is still available within the asset for consumption and helping a business generate more revenue. All right. So as you can see, we ended up selling this asset for a higher price than what it had in terms of economic output remaining. Therefore, we obviously made a gain on sale for selling this asset, and that would be the difference between $60,000 and $57,600, which would be $2,400. So that gives us the option for part B for this question, for answer for part B of this question. All right. Now, part A requires us to do all the journal entries to record the sale of this asset. And there are many steps that we need to follow, mainly 3 steps. So the first step is to remove the original cost from the books of the business for the specific asset which the business has sold. Now, whenever you buy an asset in your business, your assets go up, and when assets go up, we would debit it. But now that you are disposing or selling an asset, your assets would go down, and therefore you have to credit it. So the first thing you do is to remove the original cost from the books, which is to reduce the asset, and we reduce the asset, we credit it. So we credit the motor vehicle at cost account, and that is $90,000, which is the original cost as mentioned in the first sentence of the question. And why are we removing this asset again? Because we have sold it. So the opposite entry will be to debit the sale of non-current asset, all right? Because the sale of non-current asset here refers to an event that has taken place. And within the sale of non-current asset account, you're going to record $90,000 to reflect the original cost of the asset that you had sold. All right, what's next? Next step is to remove the total or accumulated depreciation. Now, accumulated depreciation in itself is a contra asset account, which is what we always credit by default. This means when accumulated depreciation increases, we credit it. And why do we call the accumulated depreciation account a contra asset account? A contra asset account records all the reduction that is relevant to an asset account, which in this case would be the motor vehicle account. So as the motor vehicle is used in the business, it goes through obsolescence, wear and tear, and therefore value is lost. And to capture the total loss of that value, we store it in a contra asset account, which is the accumulated depreciation account, which is normally what we credit when it increases. Now that we no longer own this asset because we have sold it, we are to remove the accumulated depreciation we have got so far in our books. And how do we do it? We debit it to reflect that reduction. So we debit the accumulated depreciation of motor vehicle account by $32,400 and credit the sale of non-current asset account by $32,400. Now, you might wonder, how did we get $32,400 from? All right, so let's recall some numbers. So we originally purchased the asset for $90,000, right? And when we sold this asset, the net book value was $57,600. This clearly shows the asset went down in value by $32,400, right? So that is the total reduction, which is the accumulated depreciation, right? And this can also be verified based on the depreciation you had got in year 1, which was $18,000, right? And in year 2, where you got $14,400. So when you add $18,000 and $14,400 together, you would get $32,400 in accumulated depreciation, all right? Another thing that we just saw, which validates the reducing balance method being used, is the fact that in year 1, you got a depreciation of $18,000, which was derived by multiplying the given rate on the cost. But in year 2, we derived the depreciation by multiplying the given rate on the net book value. That gave us a depreciation of $14,400, right? So you can see the depreciation is clearly decreasing from year 1 to year 2, and therefore fits the definition of a reducing balance method as well. All right, so back to the journal entries we were doing, where we just proved how we got an accumulated depreciation of $32,400 and the justification behind why we debit that specific account and also why we credit the sale of non-current asset account. All right. The last step to do is to record the way we sell this asset. All right. So because we're selling this asset on credit, we have a current asset who is Mr. Ong. And because this current asset is not tied to the regular operations of the business, like Yasmin Trading is not running a business where a car is sold or bought, right? They're running something else. So therefore, we can't call it a trade receivable because it's not a credit customer who is tied to the regular operations of the business, but rather a non-current asset that has been sold. So therefore, we use the word other. So we say debit other receivable, specifically the account for Mr. Ong. So obviously this refers to the fact that our current assets are increasing and we sold it to him for 60K. And the account to be credited is because we sold it. So obviously the sale of non-current asset account by $60,000. All right. Now let's go to questions. Let's go to part C. So state how the gain or loss on the sale of non-current asset will be shown in the statement of financial performance for the year ended 31 December 2022. Now in the statement of financial performance, which is your income statement, as we have just discussed, the sale of asset is not a regular business operation thing. Therefore, we show it under other income, whatever gain we had made, because this gain is not from regular business operations, but rather from other activities. All right? So you show other income, that's a separate section, and underneath that section, you show the gain on sale of non-current asset, which is $2,400. Part D, state the valuation method for non-current assets in the balance sheet or statement of financial position. So in the statement of financial position, when we show the non-current assets, we show the cost, the accumulated depreciation, and then we find the net book value, which is the difference between the cost and the accumulated depreciation. And the net book value represents the actual economic value that is remaining within the assets for consumption by the business in future years. And therefore, the net book values for these assets are what should be added to find the total value of the company. All right. So therefore, the correct valuation method is to use the net book value, which is to show the difference between the original cost and the total or accumulated depreciation. Part E. Identify 2 examples of non-accounting information which may be used by a business when choosing which asset to buy. All right, so this is pretty straightforward. Now, whenever you want to go buy something for your family or for your house, and the way you decide it is if you're buying something that's costing you a lot of money, let's say at least $1,000, you would want to check the reviews that may be available online. All right, in this day and age, everything can be verified. All right, so therefore, customer reviews is one non-accounting information which can definitely contribute to whether you decide to buy that specific asset or not. And the other thing is whether this asset is actually a necessity for you, or does it actually solve a problem or a pain that you have. And therefore, you are definitely looking at the purpose or feature that this asset brings or contributes into your life. If you want to look into other factors, you could talk about warranty in the sense that it's a non-accounting information, and if you have a longer warranty or a shorter warranty, a longer warranty gives you more time to test out the product, and therefore, if the product is defected, you can claim your money you can claim refund, right? So these are some factors that we could look into. You just have to write any 2, and you'll definitely get full marks. All right, so thanks for your patience and concentration. So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel and check out my program, which I'm running every month. It's going to help you prepare and ace your exams that you're taking in the next year. With that being said, I'll conclude today's lesson and I'll see you in the next one.